got an interesting email from Chuck. And Chuck said, like a lot of your members, I receive dozens of webinar invites every day. One webinar I attended earlier today was presented by a well-known option guru who chose not to answer my question. She was recommending a pair of vertical spreads, bull and bear, for the same stock. Essentially, that is an Iron Condor. I asked her, why not use an Iron Condor, and she ignored me. But the main question here from Chuck is, do you see any advantage in entering such positions using two vertical spreads instead of using an Iron Condor? Yes or no? I'm not sure what content she was talking about, but we're going to discuss that. I don't know why she didn't answer your question other than the webinar that she was presenting may have been based on a specific idea, and we're going to talk about that in a moment. Now, Chuck says, the only advantage I can see, and it may be a good one, is that I can easily repair or quit one side, leaving the other to hopefully make a profit. Well, you can do that if it's an Iron Condor, if it's a different Condor, and so forth. But let's take a look. And what I mean by that is, let's all make sure we're talking in the same language. Now, an Iron Condor is a combination of a bull put credit spread. So let's say we had a stock trading at around 385, okay? Right around in this area. So what I might do is sell the 370 put and buy the 365. Nice 5-point spread. I'm 15 points out of the money for maybe a 14 or 20-day trade. I'm in a bull put credit spread where I have to cover the margin. On the call side, I might do the 400, 15 points away, equidistant, and 405. Sell the 400 call, lower strike, buy the 405 in that case. So again, we'd have to put up the 5 points of margin. We receive 2 net credits, and that's our maximum return as long as the stock stays within that range between 370 and 400. And that's our Iron Condor. Pros, we get a credit up front. Cons may have 2 different margin requirements depending on your broker or how you enter it. Most brokers that know that you're entering an Iron Condor may only charge you one side of the margin or the other because they realize in most cases you can only lose on one side of the spread or the other. You can't simultaneously lose on both. You can lose on both if the stock falls and you close down this leg of the spread for a loss, and then the stock suddenly recovers and has a big jump, and you can lose on this leg. But if you were in the Iron Condor and your broker only charged you the one margin requirement on the bear call or the bull put side, so you already had your margin covered, the 5 points there with our 370, 365 spread, once you close this out, because the stock started to move against you, you'd have to have that 5 points just transfer over to this bear call. Okay, so you're still only putting up the 5 points if they let you do that. If I leg into this Iron Condor, my broker may see it as just a bull put and a bear call, and I may have 2 margin requirements for putting up $10 for each of the contracts I trade. Okay, so that's your Iron Condor. 2 credit spreads, credit received up front, margin requirement on 1 or 2 sides depending on your broker. Now, are we talking about the Iron Condor, or are we talking about a vertical spread and combining 2 vertical spreads in the sense of creating an all put condor, meaning I'd still do that bull put credit at our 370, 365 strike, but instead of doing the bear call, I'd open a bear put debit with the same strikes, 400 and 405. This now creates an all put condor, 1 credit spread, 1 debit spread, but it gives me a similar risk reward profile. Okay, and Chuck, you said that you were talking about a plain Iron Condor. I understand that. We want to take a look at these 4 because I think the question is valid as to, is there a big difference between the Iron Condor we just covered, the All Put Condor, the All Call, which is still that bear call at 400 and 405 that we would have done in the Iron Condor, but now we do a bull call debit. So we sell the 370 call and buy a deeper in the money 365, and we might be paying somewhere along the lines of 460 or 470 on a debit here, and still getting the 30 or 40 cents credit on this side. So we'd have a debit here, but we may still have to cover the margin, and that would be your all call condor. And a fourth way of looking at it actually, okay, is this is your all puts using a credit and debit combination, and debit and credit combination for your all calls. You could just take the two debits and create a debit condor on the same stock, where I do a bull call debit and a bear put debit, and this creates the debit condor. No margin required, but I'd be paying out, I don't know, $9.20, $9.70, 60 cents. So if both debit spreads work out, with the stock staying the same price, here's my bull call debit and the bear call. Let's say my total debit in was $9.60. Well, if the stock stays between that the 400 and the 370 strike, I close both debit spreads for the $5 profits on both sides, paid $9.60, get 10 back, so you still make 40 cents off of $9.60. These are all parity trades of one another. Iron Condor, All Put Condor, All Call Condor, and the Debit Condor. What your investors trade off between the four of them is because, well, does one give a slight edge over the other if you can get filled at midpoint? Is one giving more bang for the buck than the other, even if it's comparing a full debit condor here versus the full credit in the iron condor position? Now, let's just take a look at this. Let's compare, let's compare those four different spreads there. Iron Condor, you get the credit and may only be one margin. Now, the all call or put is going to be done at a debit. The one debit spread you're doing is going to be much higher than the credit you receive on the other side. And you may still need to cover the margin requirement on that position. Depends on how your broker looks at it. Now, the all debit, no margin, higher crossed up front. And what is another advantage of the all debit condor, where I do the bull call here? So I'd be selling a maybe in the money 370 call and buying the 365. Well, if you get assigned early, your broker is going to automatically exercise this long to deliver that short. You're going to get the $5 back early. Now, if the stock fell, your short call is now out of the money and you're losing value on the long call. But in the case that you did the credit side, bull put credit or bear call in one of those combinations, at this point you might be assigned early on that short option. And as we talked about last week, Chuck, this is where you may be forced to buy shares of stock and not have the monetary amount to cover the stock purchase. Or on the bear call side, goes above your short call, you may end up being short the stock here, which your broker might not allow depending on what you're allowed to trade. Now, you don't have that with the debit spread. You never have to worry about early assignment because your broker would most definitely exercise the long to deliver the short if you were assigned early, and that actually works in your benefit. If it falls, this call is now out of the money, where the bull put would be in the money. So that kind of gives you have no fear really of early assignment, because even if it happens, that's what you wanted to have happen with the debits over the credits or the all call or the all put, depending on which direction the stock moves. Now, all that being said, let's take a look real quick. And we're going to go to power options now to review the four different spreads real quickly. And that's also going to give me some benefit to discuss what you were seeing in that webinar earlier today, Chuck. In that case, that may or may not have been what the other guru was referring to, okay? So, let's just go to custom spreads. I'm just going to build an Iron Condor. Am I going to use Netflix? Why am I going to use Netflix? Well, because that's the one I was based on when we just did our fake example there. So here we are at, 286. Oh, I thought it was 386. It's 286. My apologies. So, but we're going to do the same thing. We're going to take a look at possibly a 270, 265, simple 5-point bull put spread. Okay? And then we're going to add 14, 15 points up, 300 to 305. I was 100 points up. I was using the 400, 405. Okay? But this is going to be our Netflix Iron Condor. Sell the 270 put, sell the 300 call. Just do one contract. Okay? And we're going to get the breakdown of our position. All right, so with some of the midpoint prices, and they were probably going to get around $100, $38, $39 net credit. Probabilities might not be as wide as we'd want. I'd still want to have about an 85, 87% probability between, meaning an 87 or 85% or more probability that the stock would stay above 270 and at the same time below 300 in our range to get the maximum profit. This is a bit high though. Usually for a 14-day out spread, I'd probably expect to see maybe 18 to 20. 38 means I'm probably taking a probability I wouldn't want. But in any case, let's just stick with this example. So we're going to get a net credit of about 138. And the margin requirement here, the total requirement, says 500. And that's based on assuming your broker would only charge you one of the sides of the 5-point spread, because you can't technically lose on both at the same time. A lot of the online options brokers understand that. If you enter it as a flat Iron Condor together, they might only charge you only on one side or the other. Okay, not both. I don't have to cover both spreads. The true risk is, let's call it 362, right? And that's because even if Netflix suddenly gapped up, went above my higher strike price in this scenario, and I took the maximum loss, I keep the 138 net credit. So although it cost me 5 points to close this out, to effectively buy to close my short call and sell to close the long, or if I ended up being short stock here at 300, I could buy stock at 305, even if it was at 350, 360, 370. And so I take the 5-point loss, but this was already put in my account, so the most I can lose is 362. And that's your 38.2% return. Okay. Now, again, the Iron Condor, one of the issues here is that if the stock moves slightly above the short call strike price here or below the short put strike price, you may be facing early assignment and the long option coverage has not kicked in yet, which may result, if you're early assigned in that scenario, if you haven't closed yet, is buying to close the short put and, buying to close it, but you might also be able to buy shares of stock. That is the obligation of the short put. Here your obligation may be to be short shares of stock on a stock that's now showing an upward trend. So that would be bad. You still have the long option to protect against the maximum risk, but it hasn't kicked in yet because it's still out of the money where your short went in the money. All right? Now, if I made up my mind, Chuck, and this is the real crux of your answer, I don't know what advantage, and you asked, and I guess she didn't answer it either, but I don't know what advantage the other guru was saying about doing a bull put first and then doing a bear call. Unless she was referring to doing the bull put maybe now, when we're 14 days from November standard expiration, and then 3 days later, if the stock moved up and I can get a higher credit on this bear call, to go ahead and do it then, legging into an Iron Condor. Now, there's a benefit of that, naturally, because you get a higher net credit on the second side, or you gave the stock time to show more of its hand, and you're more comfortable or confident in the new strike prices, okay? That's what I can see in this case. But again, what I don't like about legging in, number one, or even if I open the bull put this morning at 10 a.m., Chuck, and then open the bear call at 2 p.m., I would have gone to my broker and I would have said bull put credit spread or spread entry, put in my limit, got my fill, had to put up the margin. Hour later, 4 hours later, I enter second spread, bear call, and they're going to require me to put up the 5 points of margin. They might not recognize this as an Iron Condor, just as a bull put and a bear call. So I would actually effectively have the two margins. Now, another thing I would have said in the old days is when I was trading Iron Condors, I haven't traded an Iron Condor in almost 4 years, I'd say, or legged into one. But when I was trading them, and for a while I was using Options Express, they had a, $7.95 and it dropped down to about $5.95 per option contract. Okay, so but I remember when it was $7.95, if I entered in a spread, they had the X spread field or whatever they called it. When I entered in a spread, they didn't double this to 15. It was only 10.95. But if I entered a 4-leg spread as an Iron Condor, this didn't double from the regular credit spread. I think the total charge was only $15.95, which is still a lot, but I've entered 4 options at a cost here, okay, of $15.95. Now, if I had done the bull put at $10.95 and then did the bear call at $10.95, that's going to put me at about $22 worth of, $22 worth of premiums. That's almost a 50% increase what I was paying for commissions. That was in the old days. Now, with everyone fighting to lower their commissions, get their commissions to 0, to be competitive with one another, we're not suffering that at all, okay? But in the old days, I would have said that the commissions would have been an issue in that case, opening together, and I think the fact that you'd have to pay 2 margins. If this is my sentiment for Netflix, between those strike prices, and my broker only requires me to do 1 margin, then I'm going in right away. I'm not going to wait for the stock to move up so I get a little bit better net credit here and then have the 2 margins, or the stock to fall to leg into it then. I'm going to open the Iron Condor right away if it matches the probability I want, the return I want, the credit I want, and is in the range to upper lower break even, we might say, or in the range we expect. I don't think I would go in. I don't see a direct advantage of doing that based on those 2 or 3 points we just mentioned. I honestly don't. If my sentiment is the stock is going to be neutral, I don't think I would go into them as 2 individual spreads. I'd go in as the full Iron Condor with 4 legs, unless for whatever reason my broker doesn't have a format that allows me to enter 4 legs, that they force me to enter a vertical spread as 1 spread and then the other spread as well. Okay, so what would we do? What would the all call Condor look like? Remember, we do the same bear call. Sell the 300, buy the 305. But now I'm going to do a bull call debit instead of the bull put credit. We're going to sell an in-the-money 270 November call and buy a deeper in-the-money 265. So one of the problems here with looking at doing the debits here is you get a wider bid-ask spread because they're deeper in the money. We're looking at almost, it's not too bad though. Here it's 70 cents, I think. Yeah, we're looking at 70 cents, and here it's 70 cents as well. Up here though, it's only 25, 35 cents, 20 cents with the out-of-the-money calls and the out-of-the-money puts. When you get into the deeper in-the-money calls, the deeper in-the-money puts, start to see the bid-ask spread getting a little bit wider. All that means is that it might be slightly harder to get filled at midpoint. But same action, sell the 270 call, buy the 265. Now we're going to enter that as a debit. And our debit here is going to be close to that, the difference between what we get for selling, which is $18.77, and then buying at $23.20. We still get the credit on the bear call, but look at that, $3.58. Let's call it $3.59 as the debit. That's the risk. That's the most I could, well, it says total requirement $8.58, and that's true. The most you can lose, though, is this, the $3.59. And the max return would come out to be positive 41.7%. In this case, because of midpoint pricing, if you could get midpoint pricing, this gives you a little bit more bang to the buck. Regular Iron Condor was 38.2, and now it'd be at 41.7 because the maximum risk is 359 instead of 362. So the maximum profit, of course, would be roughly 141 as opposed to 138. It's nickels and dimes, I understand, but that's, hey, more bang for the buck. And what happens? If the stock stays between the 2 strike prices, my bear call, this is the all call now, my bear call still expires worthless as it would in the Iron Condor, but now I close out my debit spread to get that 5 points back to cover the risk of 359, and there's my profit of 141. In the old days, again, what would I say? One of the disadvantages here is to get that maximum profit, I'd have to pay another 2 commissions to either buy to close my short call in the debit spread or sell to close the long, or if I let it get exercised, left the in-the-money debit spread alone to expiration, effectively what my broker would do is buy shares of stock at 365 and sell it at 370. And that might be 2 stock commissions. So if I close actively, I'm paying 2 options commissions, Because of bid-ask slippage, I might not be getting the full 5 points back. I might not be getting the 141. Or if I allow it to be assigned, I might get charged 2 stock commissions. That's in the old days. Now everyone's fighting to lower commissions to 0, so that's not really an issue anymore, but it does take us an extra transaction on the all call or the all put condor to close the position out at expiration. It does take an additional transaction instead of having everything expire worthless. All right, and just for giggles, let's just take a look at let's go back to our bull put as well, and then we'll do the all put, just look at the numbers. And would I leg into this one as well? Again, if my sentiment is here, Chuck, this is what I'm expecting Netflix to do, and this is not an expectation, recommendation, or suggestion of where I think Netflix is going to be in the next 14 days. This is just our example to compare 4 condors together. But in this case, would I leg into it? I don't know. If my sentiment is here, that the stock's going to be between these strike prices in 14 days, and this is my target return, and I'm meeting my target goals and my target risk, why not enter it all at once? I don't know what the advantages of legging unless they're trying to get a little bit better premium on one side or the other, which is possible, but is it worth fighting over 5 to 10 cents? Okay, so let's say in either scenario. Let's say I entered my bull call debit first because it looked like a good price, and I did it at the open when the stock was at 280. And I still did the 270, 265. But my expectation today was the stock is going to go up from 280 to 285, and this spread might give me a little bit more bang for the buck, an extra 10 or 15 cents. Maybe that's why they were talking about doing it that way. I don't like to time my trades that much. I like to go in for the target and see what I'm expecting to happen, get it. Why? Because what if I did what I just mentioned and I opened the spread when the stock's around 281, we opened our bull call debit or our bull put credit here for a premium we wanted, but we thought the stock was going to show movement up to 285, so we hesitated on the call side. Well, what happens if the stock falls down here to 276, 277, for example? This is lower. Now I'd have to take lower strikes to get that credit I want, and it might not give me the probability or the width that I wanted initially. Okay, I'd rather look at this as one full trade first rather than trying to fight the two sides to maximize the return. What is my goal? To have the stock stay between the strike prices, get a price where it matches my return. I'm right there already, have the risk I want already. Why not just enter it right away? That's my opinion. And they probably had something in the webinar that they were discussing that was different, that they have a probably good reason for doing this, otherwise she wouldn't have been presenting it. I don't know what it was, and you didn't get a chance to see what it was, and she didn't answer your question. So there's an advantage they see there. I just don't know what it is. Personally, I look at this as one full trade rather than trying to maximize a little bit of extra net credit for 10 cents, 15 cents, or 20 cents by trying to leg in, especially leg in during the same day. All right, so real quick, and I'm going to get to that in a moment, your follow-up question, Chuck, but let me just go back here. We'll go straight in from scratch, and we'll just do the all put. All right, so we're just going to use the puts now. We're going to do our same bull put, 270, 265. We're going to do a bear put debit. Sell the 300, only a 40-cent bid-ask spread. That's not bad. This one here is a little bit higher. It's about 75 cents or so, but that's okay. Again, same structure. Got my bull put. We'll do the bear put debit. We still may have to cover the margin. The obligation, rights and obligations of this debit spread is not going to help us cover the obligations of the credit spread. So again, the monetary requirements, the debit we pay in plus the 500 we have to cover on the other side of the spread. But again, the most we could lose is 364 in this case. So this is actually 2 cents higher with midpoint pricing. Return drops down to 15.7%. I have to look at that. I think that's actually a miscount. Max profit of 136. Yeah, this one here I think is looking at it wrong in this combination. I think what it's looking at is 136 versus 863, which is still good, but it should be based against this and still be in that 38% range. So it's 136 over 364, 2 cents off in this case at midpoint. So this is the least of it. And we've got a bear put debit spread now with an in-the-money short put and an in-the-money long put. We could be assigned early at any time, but again, our broker would exercise the long put to deliver the obligation of that short put in the money. We might buy stock at 300, then our broker would exercise to immediately sell at 305. We got the 5 points back early, and we'd just be in the bull put side, but we'd have to do that as well. Okay, and again, if the stock stays below this strike price, I'd have to actively close this bear put. So another transaction fee. Now it doesn't matter so much, but that's still one of the issues there. This I know is wrong. I'm marking down a note here to talk to the programmers about how that did not show up correctly. I don't think it's basing it off the right price. Okay, but is it the exact same risk-reward profile? Yes, it is. Exact same risk-reward profile, exact same things happen at expiration if the stock's at any price, in the sense that I'm going to be a loss up here or at a loss down here. Max profit is achieved in here. Max loss is achieved outside the two long options. Same as the iron, same as the all call. So far, the all put has the lowest price at midpoints. Very quickly, just for number's sakes, let's keep the bear put debit on. Let's add that bull call debit we saw from the previous one. So we're keeping our 300, 305 put. Going to add in, I'm sorry folks, we're going to add in that November 15th bull call debit now. I know it gets confusing with the 4 vertical spreads. We're just using this as a quick comparison. 270, 265. Wider midpoints, that's okay. Sell here, buy that. Going to give us a similar risk-reward profile as we'd expect. And in this case, the risk is actually the best one on the debit spread, if you're able to get midpoint. What do I mean by that? Max profit of, max risk of 361. Okay, so that's the, the all call based on midpoint was still there. So this is a 361 with a 5-point difference. It'd be 139. Okay, 139 max profit for the 361 risk, and that's going to put us right at about 37%. It says minus 41.8, but that's something weird's there. Okay, so they're all very similar, all same risk reward. But again, let's briefly talk about what we're seeing here and why. And we saw that all 4 were parity trades. In the Iron Condor, what is it? We get a credit up front. If we open it all 4 at once, we might only have 1 margin, right? But if we leg in, it's greater than legging in and having 2. Okay, for 2 margin requirements. We knew what we wanted initially. We knew our upper and lower break even. We thought the stock was going to stay in this range. Why not just open all 4 at once instead of trying to hope for a better nickel, 10 cents, or 20 cents? The all call and the all put, well, you pay a debit up front for the debit side of the spread. You still get the credit from the other, but then you still have to have 1 margin for the credit spread. But again, same risk-reward profile, and this would cost an extra transaction to close at expiration or before expiration to get the advantage or to get the premium back from the debit spread. And as you can imagine, the debit condor we saw, still similar risk rewards, but we paid 2 debits, and that was that total cost in of 860, 861. That's what we would have paid. We would have paid out 861 directly. And in these 2 here, we would have paid the original debit of 360 plus putting up 5 points of margin. This one here, if we opened it all 4 at once, we might only have that 1 margin of 360, 362 it was. Okay? Here we're at 860, putting up the margin and paying a debit straight out. 862, 863 is kind of where they were. Paying the margin, paying the debit. Here's the 2 debits straight out of pocket was going to be that 861, okay, in our case. So the total debit for 4 legs would have been 861. We can get $1.39 back at expiration by closing those, so that would actually then require 2 full transactions to close both in the money debit spreads. That's the difference. I think it takes more action and more transaction fees to do the all debit condor. But you remove the fear of early assignment. Okay, you don't have to worry about that at all because you're in a debit where the long leg is deeper in the money than the short. It's already covered. So the real summary here, well, this is what we're looking at, combinations between all call, all put, all debit condor versus the Iron Condor. So whenever you ask me, Mike, why do you show, Iron Condors? What's the advantage of Iron Condors over doing the straight call and straight put Condor? Well, I tell you that if I can only get the one margin at my broker, I'm only putting up 300 or a small portion, 3,000 if I did 10 contracts. That'd be 3,600 in my account. Whereas here I'd have to pay that 5-point debit and still cover the margin, automatically putting them more. Yes, the risk reward is the same, and I'm removing half the fear of early assignment, but my triggers are already stopping me from that in most cases anyway, unless there's something unexpected, some black swan across the market or on my individual stock that I couldn't see. I'm not worried about early assignment on my credit spreads or my Iron Condors if I'm trading those. And then the debits, well, you still pay all of that up front, higher cost in. And then you'd need the extra 2 transactions to close it, but you do remove fear of early assignment if that is what you're worried about with doing the Iron Condor with the 2 credits versus doing the Debit Condor with 2 debit spreads. Those are all parity trades of one another. And again, as we talked about, the advantage, I'm not clear on what they were saying the advantage was, Chuck. They had something in mind that they were teaching or that they were showing, and from the beginning, I would just, if it matched my goals, I just do the Iron Condor outright instead of legging into it, unless I'm completely missing something, and it might be very minute. That's a small advantage that I don't know would sustain. Now, keep in mind what I do too. You all know, and many of you, those of you who are new, but probably don't know this, but many of you who have been in the webinars before know that when I approach any strategy, bull put credit, calendar spread, Iron Condor, I have the plan in my mind to enter the position that way if the return, the probability, the stock direction all match my base criteria. Even if I'm doing a weekly spread that's only 5 to 4 days out in time, I'm not going to try to outthink myself or put myself in a worse position by trying to time the trade and aggressively leg into it for an extra 10, 12, or 15 cents. My goal is a trading plan. I want bull put credit spreads that match this probability I want, return I want on these types of stocks that have been successful for me, and I'm not going to outthink and say, well, it looks like the stock's moving down a little bit, so if I wait 30 minutes, I might get a better net credit of 3 or 4 cents. I'm not really going to worry about that. So my goal is to make X average target 87, 85% of the time over the course of a trading year with the bull puts or with the Iron Condors, get the return, minimize my risks so I know that I'm within my trading plan rather than trying to fight to leg in, leg out of positions in that case. As far as closing goes, Chuck, you had mentioned the question, is there a problem of getting out of one leg or the other? I've never had an issue, and in fact, most of the times when I close a bull put credit spread that's moving against me, as I would be doing in an Iron Condor if the stock started to move down against me, I'm only closing usually the short option, depending on the situation, but that's just like buying to close a short put. There's going to be liquidity there because it's getting close to at the money, okay? If my option is so far, if the stock fell, now my bear call side or that bear put debit on this side is further in the money for the bear put debit or further out of the money for the bear call spread side, well, and I'm fighting the market maker, say, hey, I want to close this for 5 cents, and they're saying, well, no, we want 7 cents. Well, why not just leave it alone? I'm not going to worry about closing that side early. It's doing well. Just leave it alone, and I'll get the full price for it. Okay, so yeah, which is best? Those forward condors we looked at, that's going to come down to your personal philosophies. I've shared with you mine. These are all parity trades. All types of those condors are parity trades, exact similar risk reward, off by only 1 or 2 cents. There are some pros and cons of each, so you'll have to decide. For those of you who are following along with the discussion, you'll have to decide which one best suits your needs in that case. As far as legging into an Iron Condor, I think I've been clear on that. I don't see the advantage of it. Anyone has any thoughts on it here, I'd love to hear it. I just don't see the advantage of legging in to a shorter term condor that's 5 days out, 14, even 20 days out. If I saw the position, it had the probability, and it had the return I wanted, and I can get in for only one margin. I'm not going to worry about legging into the position. Okay? All right, so let's go back to power options now. Let's just start reviewing the four basic condors there, the four forms of condors, I should say, and the kind of same rules apply for butterflies also in that case. All right, so let's just go back to that, and let's see what we've got here. Okay. Now, Sam comments that he does both. He does do the Iron Condor and does debit spreads as well. Okay, so depending on what price you can get, there's nothing wrong, by the way, with comparing those two. There's nothing wrong with comparing those four. In fact, a lot of times, if I was interested, and I probably wouldn't have been, but let me take a look here. Let's go to a 5-point spread, and I'm going to look for a minimum return of 5%, 85, but I'm going to look on Netflix. Okay, let's say I was interested. This is our spread chain tool. And let's say I was interested here. So yeah, I knew that those returns were too high. I'm going to be at the 265, 260, probably here, 265, 262, excuse me, 262 and a half. No, I'm sorry. This would be my preferred bull put spread if I was doing one. Oh, no, sorry. There we go. For 14 days out. It's not close. I'd have to, let's go 83. It's probably going to be 82, I'm sorry. All right. This would likely be my preferred spread if I was open, and it is. Hey, look at that. For the November 15th expiration, 14 days away, the 270-265 would be my preferred bull put credit spread because it has the probability. I usually like 85% or higher if it's there, but I want to return 13, 14, 12%, maybe a little bit higher. Okay, that's what I'd be looking for if I was opening a bull put spread on Netflix on Monday. If the numbers were the same, this is the strikes I would choose. Now this credit spread view up here on our spread chain is showing me credit spread, the bear calls that match this probability I want, this return I want, and net credit. Bear calls on this side, 305, 310, 310, 315, and here are my bull puts, all the way down to the high probability, but only a 5% return. But I can look at the put credit and call debit parity. Okay, let me just change the numbers there. And this gives me my bull put credit, which we know is on that 12% return, 84.5% probability. But hey, if I get midpoint on the bull call side, the return actually goes up to 13%. It's a full percent higher if I can get filled at the midpoint prices. So where am I going with this? I've done all my research and analysis. I've looked at it. I decided that, yes, I was going to open a bull put on Netflix. I have my trading plan. I look for that 85% probability, greater than a 9% return, but I really want to target that 13% range. This would be my target for 14 days out. But then I go to this tool, and I do look at the put credit and call debit parity, and if this is significant, I'm going to try to open the bull call debit and get that spread midpoint so I can get that extra return. Now that commissions are lowered, now that commissions are going to zero, I don't have to worry about the extra transaction fee so much of closing out the debit spread when the put spread would have expired worthless. This is only 5 or 6 cents, might not be worth it if I'm only doing a few contracts, depending on the commission costs. But now that's being alleviated, so this extra 1% return on a parity trade with the same risk-reward profile, above 270 we make max profit, below 265 we take the maximum loss. If that's my sentiment, the bull call debit might give me better bang for the buck if I get filled at midpoint as opposed to the bull put credit. So I might try to enter that first, and if it doesn't fill, then I might just jump over here and get into the credit spread side. Not both at the same time. No. Just still do one or the other. Okay. All right. So that's a useful tool, a powerful tool to use to look at parity trades and more. Okay, Sam says, regarding my other comment, Apple, in advance of earnings, I've got bull put credit spreads and debit spreads on Apple going into the earnings as well. Okay, All right. Oh, and Chuck, thank you very much. Yeah, Chuck says that's you know, kind of what he was thinking as well along those lines, and you hope his questions are too much and benefit others. Yeah, we covered. I spent extra time on it to cover that extra thought of comparing the four spreads, which wasn't related to your questions, but it always is nice to see, and it's always nice to remind ourselves that any position we're opening likely has a parity trade that has a similar risk-reward profile and might be worth a look, especially when we're talking about the four vertical spreads or combining two vertical spreads to any condor. That gave us the four options we could have likely done: straight iron, all call, all put, or all debit vertical spreads, and we took those pros and cons. So I think that was useful for everyone, and I appreciate the question, Chuck, to give me the opportunity to do that.